Hello, I'm Greg Hunter. Thank you for joining us today on USAWatchdog.com. Today, Ira Harris, he has been called the trader's trader. He found more than one reference as he has been called a trading god. You may see him commenting on his notes from the Underground blog, also on JS Mindset. We have Ira Harris today with us to uncomplicate things. Hello, Mr. Harris. How you doing?
Greg, how you doing? It's good to be here.
Well, I know you specialize in commodities, currencies, futures, which to me tells me that you have to know a lot about a lot to be able to trade in this market in so many levels in so many countries and trade globally. So let's start with the latest news out of Greece. They've cut some kind of a deal. They've taken 15-year notes and turned them into 30-year notes, and there was $44 billion. Basically, without saying that, there's debt forgiveness. Why should anybody in America care about Greece, and what does it mean to the rest of the Eurozone, particularly Spain and Italy?
Well, what it means is that, let's take a step back. I think 2 weeks ago I blogged about that there was a rumor out of Germany that there was going to be some type of deal. And the deal that was rumored is actually the exact deal, except that the Germans were only proposing a 25%, a haircut of 25% on all those bonds. From what I'm hearing in the deal, you can't get the truth ever out of Europe. It's just a fact. One thing you can be sure of is that they're going to lie. So it looks like about 35% of the haircut's going to be that they'll get 35 cents on the dollar out of the private sector. Now, that's not the public sector who's going to own all this debt anyway. So they're going to extend, they're going to pretend and extend. So they've taken the debt and probably will roll it down to about 15 to 20 years, and they're going to cut the interest rate, basically. So the Greek government will be able to basically borrow from the public authorities in Europe at about 1%. So that'll save them quite a bit for a while and will bail them out. And what it does is it allows Europe now and the IMF to go tackle the real problem, which is Spain.
Spain, and then closely behind is Italy with their 2,400 tons of gold. What does that do to the U.S. dollar? I mean, we are basically have currency swaps open there. That's never talked about. We are backstopping basically the EU and the European Central Bank. What does that mean to us in America that now they've cut a deal with Greece and they can move on to the bigger debtor, Spain, and there's all the other debtors like Portugal, Ireland, Italy. Won't they want the same deal? Don't they want all their debt cut?
Well, they're all going to push for the same deal, which is why, the politicians who think that they're smarter than everybody, all this will come back to haunt them, because Ireland's going to ask for some type of forgiveness, because Ireland is also suffering under the same austerity type. They've done it better because they're a much better equipped economy than the Greek economy. The Portuguese they've been muddling around here. Italy, we're not sure about. Italy isn't Italy doesn't run the private sector debt. Yes, they run a heavier public sector debt, but the Italian economy is not built on debt on the way that other countries are in Europe. They're not. The Italians just are not kind of power. They really may be able to muddle through there. As a good friend of mine, Bernard Connolly, has argued for years, it's more the expense of that debt for Italy. So that's what it'll take. At what level will they be okay? And what level will the euro have to be? For the northern parts of Italy, for those manufacturing sectors to be able to export to really boost that economy. The euro right now is way too strong. It's just way too strong. But that's more a reflection of the dollar. Because don't forget, when we talk currencies, we're only talking relative value assets. Currencies are always relative value. There's no absolute values to currencies. So this just allows, the problem is Spain right now. It's Spain. Because Spain is big, they're in debt, and they have 26, 27, 28% unemployment. That is a problem.
Aren't they ultimately just going to end up forgiving debt and printing currency, and we're going to backstop that? I mean, isn't that what we're doing now here in America with $40 billion each and every month going to buy the mistakes of bankers, and then the Operation Twist, which is they're going to run out of these securities, so it'll be $85 billion a month of just money printing? I mean, aren't we debasing our currency too here in America?
Well, it all depends which view you're taking at. You and I may sit there and say, well, this is ultimately currency debasement. I go back, and it's interesting that people always want to talk about Rogoff Reinhardt. Well, Carmen Reinhardt in March of 2012 came out with a great paper on financial repression. And it's eminently readable, as she writes very well for an economist. And people should read that as about how countries repudiate their debt. Because that's what you're talking about. You're talking about debt repudiation. It's as old as mankind, whether you're clipping coins or whatever people have done, or taking the good, Gresham's law, taking good currency out of circulation, putting crap out there. We've seen governments do it. It's no different now. It's the same thing. You can call it by any other name, and somebody is bearing the price of this.
And that's going to be inflation, isn't it? I mean, isn't it going to be spread out globally and here in America too?
It'll ultimately be inflation, but right now, who's the first one in line to really? Which, of course, inflation will erode them. But right now, who's being financially repressed, quote unquote, is savers, and it's not really through inflation yet. It's through the fact that they've smashed rates down so low that we are. But let's face it, gold goes up because we're in a real. When you look at real yields, they're negative. People
Yes.
say, well, when will you get bearish gold from a trading standpoint? I said, when you give me a real yield, when real yields go positive, 1%, 1.5%, 2%, I said gold will have a correction. Gold will have a correction at that time. How far will depend how far they'll react. But we're so far from them going to real yields on money that it's not even on my radar screen yet. It's I would say that let's use their numbers. Let's say the CPI is 1.8.
Well, that's a fantasy number, but
I'm being kind.
okay.
The 2-year note has a 25 basis yield. If you're buying a 2-year Treasury note, you are today accepting a negative 1.6 on your money.
Yeah.
That's a negative real yield. As long as real yields are negative, of course gold's going to go up. And that's why a couple weeks ago on the blog, when Mario Draghi made that comment, well, gold's going up is a mystery to me. It's not very much of a mystery, Mario. It's let me do the math for you.
Well, speaking of gold, you were writing about securitization of gold, and you said, that gold will be securitized, and when it is, it can be used as a currency. Explain.
Well, my view is this. I've heard from people that gold has no value, up and down the line. That, gold, okay. If it has no value, if it's not really an asset, or even Bernanke says it's not money, then you're foolish not to take your gold hoard, which there are gold hoards. The United States is the biggest gold hoard. The IMF has a huge, and that was my point with the IMF. So take that gold hoard and securitize bonds with it. You're busy trying to raise debt levels. And I didn't want to do it one-to-one. We live in the age of derivatives. Take for every ounce of gold, for every dollar of gold, create $5 of bond value. Do you know how many people would come to buy your bonds? You could borrow at a 2%. We've seen this before in the 60s when the French had those Giscard d'Estaing bonds, which people made a fortune buying them after the fact when the price of gold went up and found out what the underlying asset was. Why is it that all the central banks in the world are so afraid to utilize the gold that they're busy demeaning and devaluing verbally? Why don't they want to use it? The IMF sits on a huge gold hoard. Now, I know the rules of that. I think it's Article 4 of the IMF rules that they supposedly cannot use gold as a security. But meanwhile, they go out and sell it when they need to raise cash. Securitize it. If you're so, as I would say, money good, put it to work. And you watch. You want to see governments all of a sudden start to get a little responsible? Make that gold attachable as collateral for your debt, and watch how all of a sudden the whole mindset will change.
Well, the direction in the next year or two for gold, up or down?
I'd say up. Up. Because we haven't seen what Europe. Draghi's got those outright monetary transactions, which is QE by any other name, up his shirt sleeve. So we do have the German elections in September of 2013. The Germans are going to do all they can to prevent any major crisis from blowing up, because the danger is that Merkel comes up short and that we get some kind of new coalition out of Germany, which may take a different tack than what she's taking. So the Germans want to keep You know what? That's why Greece was no question going to be settled. Anybody who is not paying attention, it will be. They'll go as they can, and Draghi will pull out that outright monetary transaction as he needs it to calm the markets.
It's kind of like the Eagles song, Hotel California. You can check out any time you like, but you can never leave.
They don't want you leaving. First of all, it's too expensive. You may be able to leave, but not when the politics are on boil. You know, there may be a time, but as I say, not now.
Closer to home, USA, fiscal cliff. Are we going to run off a fiscal cliff? Is there going to be rough sledding for the United States in 2013?
Well, there's so much in play. You know, it's like somebody said, it's not the fiscal cliff, it's an austerity. Are we going to go into austerity? Well, you certainly could now. You know, if it was Paul Volcker running the show, I'd say, yeah, we could go into austerity. The election is over. If you're going to take your pain, take it now. That's just good leadership. Take it now. Okay, I understand you couldn't before the election, too much pain, but you may as well take it now. They're not going to go there. They don't have the gumption. You know, and that's not. I don't want them to push over the cliff because the United States is different. You know, everyone wants to compare us to Japan. The United States cannot take that type of contraction because we can't take a look. We saw the difference in this election. If we went to 20% unemployment, and I'm not saying that we're going to go there, but if we really mirrored the 30s, we as a society could not. I don't think we could absorb it. It's far too dangerous.
Well, ultimately, Mr. Harris, isn't the U.S. dollar and U.S. Treasuries going to force austerity when we can't sell our debt, when we hyperinflate, when people quit buying our debt? I mean, yeah, near term, yeah, we can't take the austerity, but aren't we going to get it anyway and worse when the dollar, you know, people sell those assets globally and people stop buying our bonds and we find out, hey, the king has no clothes, the Fed is not doing 61% of all of our debt, buying it, that they are indeed buying all of it.
Well, you know, it's funny. You know, there's a recent study that just came out of the IMF about absolute repudiation. In fact, the guy who was up for the governorship of the Bank of England, Ader Turner, presented it saying, well, if the bank owns the Treasury's debt, meaning the exchequer in England, why don't they just cancel it? It's like you and I playing a Monopoly game, and at the end, and you know what? That actually got a little traction. People haven't paid attention to that. There's a little traction about, hey, why doesn't Bernanke just turn to Geithner and say, hey, you know those $3 trillion worth of bonds, we're going to just cancel. Let's see this, and just throw it up. Of course, the day that happens, you as a reserve currency, it's over. Who would ever take your debt?
That's right.
Because then you'd have to ask the question, who's next?
That's what the powers are doing, aren't they? I mean, aren't they having this austerity and they want to get their money back? I mean, don't they want to get their money back? And they can't just forgive all this debt because otherwise the powers that be lose big money. And they want people to cut back and pay them. And we're talking about a value-added tax. Isn't that all part of it here in America? We need to pay the bankers back just like over in Europe. They need to pay the bankers back.
Listen, you borrow money, you got to pay. The lenders want to be paid at some point. Now, you know, I've been a big believer in, and I still believe they have a big role to play. Although others would argue with me, that term bond vigilantes. The bond vigilantes served a great purpose because they awaken when government policy starts to fail. The bond vigilantes' job is to come in and say, hey, your debt is questionable. Get your house in order.
Raise interest rates.
The market will do it. We'll do it because how are you going to stop it? So you better raise them to get your house in order. Probably the great man of the last 60 years, and was Paul Volcker because he saw it for what it was, which is, hey, nothing destroys democracy like inflation. End of story.
Yes.
Now, right now we don't get that picture because there is a debt overhang, and you're still working off that massive amount of debt, and therefore prices can't go up. But the way that the Fed is operating, they want, believe me, and the crux of Rogoff and Reinhardt's thesis is some good inflation. 4 or 5 years of 4 to 6% inflation would remove the debt load that overhangs that kind. They say it. They openly say it. People choose what you want out of it. But you and I know, or I think your listeners would agree, it's like being a little pregnant. Can you really control? You see, and the Fed, and the Fed and all central banks have ridden on the back of Paul Volcker. And I think our friend Jim Sinclair would agree with this, which is inflation is an asymmetrical game, meaning they always believe I can stop inflation far easier than I can ignite inflation, which is the Japanese story. But that's an old story because the Austrian school, which I give a lot of credence because they understood credit, that's what they talked about. But we're not there yet because we're still liquidating a lot of assets. And we're not, but it's interesting. I know we're gonna go soon. One of the interesting places that we're going to have to watch over he won't take July 1st. Mark Carney will become the governor of the Bank of England. He will be interesting to watch because he is going to walk in and absolutely inherit the same type of position. And it'll be interesting to see what he does with his boatloads of money that he's going to have to rein in.
Gold prices and your direction for that, just given this current environment of what's going on with them basically printing money on a global scale. I mean, even the Japanese want more inflation. Obviously, the European Central Bank wants inflation. The Federal Reserve wants inflation. Gold prices?
Well, they'll go higher. As I say, until I see real yield on money turn positive, and it's not. Because
negative.
Japan has had a real yield because they've had real deflation. So even at 1% 10-year notes, you were able to get a 2% real yield. They're trying to turn that now because that's been a problem for them. The United States hasn't gotten close to that. As much as we're supposedly into deflation, we have not had real positive yields. 2008, 2009, there was a great fear of it because we were in a massive liquidation period. But we're not. We're negative yields. If I'm bullish gold until real yields in the United States. Europe is too hard to measure at this point in time, but I think they're going to go the opposite way because what they're trying to do is create massive inflation in Germany. I know it's a bad word, but that's how they think everybody's going to become more competitive against the Germans.
But back to the dollar.
Yes.
So you're bullish on gold. You were saying you're bullish on gold until real rates turn positive.
Yeah, and when I say positive, I don't mean 0.1%. If they got to 1% or more, then gold will already have been a sell-off then. But then I would be much more negative, and we would see a real correction in gold. Last year at this time we were seeing the correction, but I view that was what's his name, John Paulson, as he was liquidating to meet redemptions. We had massive liquidation of gold, and you saw how fast the quarter came to an end. I think we closed at 1567 on December 30th of 2011. And this whole year we've tried to go up and come down, but we're higher for the year because there's nobody meeting redemptions this year, and the market's kind of happy right where it's at.
So where do you think gold's going to end the end of the year? Higher or lower from here?
I think it'll be higher from here.
By the end of the year?
Yeah, because, it's interesting. Some people will say, well, you got the fiscal cliff, and that'll be a deflationary impact.
Yeah.
But the gold market, and I've argued this with people for a long time, deflation from the United States standpoint is bullish to gold because everybody knows what the central bank is going to do to answer the call. So if there is that fear of the fiscal cliff, the Fed will become that much more aggressive. Bernanke told us that. Don't forget, he was the one who threw out that term, fiscal cliff, at his April 2012 press conference. He's the one who threw it out there. You must deal with this because we're coming to it. There tells you that the Fed, they can't allow it. It would undermine, it would put, in Bernanke's vernacular, and I'm going to put it in his vernacular, and he can come out and tell me, for him this would be 1937. And for everybody who pays attention to Ben Bernanke, he promised Milton Friedman that there would never be a 1937.
That means he's going to print money, and as he said, drop it from helicopters.
Well, listen, he was quoting Milton Friedman in all fairness to him.
Right.
But he will not allow, which is why he told them, get ahead of this and start, because my response is going to be, in which, of course, Chuck Schumer said back to him, you're the only game in town. It was a bad answer. And I don't think Bernanke sat comfortable with that answer. So let's see what takes place here. But If they fail to do it, I think you'd see a very, very aggressive Fed.
Ira Harris, we're going to have you back on again, my friend. Thank you
Thanks.
so much. You are the trader's trader. Thank you so much for enlightening us here on USAWatchdog.com.
Okay, thank you, Greg. Appreciate it.